Hello, everyone. Thank you very much for joining us for today's educational webinar. My name is Corey Daharsh. I'm with Advanta IRA, and I am here with my guest speaker, Jim Hiza, who's going to speak to you about oil and gas royalties. So again, Advanta IRA is a self-directed retirement account administrator. We handle IRAs and 401ks and other retirement plans that let you invest into alternative assets as opposed to stocks, bonds, and mutual funds. We've been in this industry for 20 years. We've got about 10,000 active clients and just around $2.5 billion in assets under management. And every client we have is paired with a dedicated client account manager, a role I served for about 5 years, so that you as a client don't have to call a huge call center and explain what you're wanting to do to a new face and a new voice every single time. You get continuity built up with your account manager, and that account manager even gets continuity built up with the investment providers. Like I said, having a relationship for a few years now with Jim, so that everyone involved in your retirement strategies, goals, and plans are on the same page, and it's a smooth, simple process. That is what we try to facilitate here, in addition to all this free education that we put out as well, like this webinar. Having said that, we do have disclaimers, and it is important to share with you all that Advanta and myself specifically do not provide tax, legal, or financial advice. Today's webinar is for educational purposes only, and we always implore you to consult your own professionals and do your own due diligence before entering any certain type of investment or any specific investment that you may be looking to accomplish. If you haven't heard about self-directed retirement accounts, that's actually pretty common. I've been in the industry for 7 years, so I've known about them just by way of finding a job with a self-directed company coming from banking and finance, but even working in banks as a banking and finance professional for years before that, I didn't know these plans even existed. Only about 4% of US-based retirement accounts are self-directed, and in the grand total, there's about 40 trillion with a T, dollars in US-based retirement accounts. So we're talking IRAs and 401ks and a few other plans I'll go over in a minute. All in total in the US, only about 4% of people that have those types of accounts, or 4% of those accounts, are being self-directed. Now, as I just mentioned, most people are familiar with a traditional and a Roth IRA. A traditional is a tax-deferred account. You pay taxes when you take it out later on in life to use that money for your retirement living. Or a Roth account means you've paid taxes on the money when you put the money into that plan, and then it grows completely tax-free moving forward. So those are great tax strategies depending on your age and your balance and what you're trying to save up for and how long until you'll need the money. Speak with your tax preparer to see if a traditional Roth account's in your best interest. Aside from those, we've got your SEP and your simple IRAs for small business owners, and a solo 401k or individual K plan if you're a small business owner with no rank and file employees or no W-2 wage earners. And then we also offer health savings and education savings accounts if you're someone with a high deductible health policy or have a young one in your life that you're trying to set aside money for their educational expenses, whether that be primary school or college school or postgraduate degree expenses. Those can all be handled through tax-sheltered education savings accounts. Now you may be thinking, okay, I do have an IRA. What is a specific reason I would go into these types of investments as opposed to those stocks, bonds, and mutual funds that my advisor is telling me I should invest into? Well, when you're considering these funds as a source of capital, you can very easily reinvest with someone or a group if you did like the way your first investment panned out. So for my case study today, it's going to be a very brief example of making an investment like an oil and gas investment. And you can really just redeploy those funds without any overhead approval because you are the account holder making all the decisions. If you're not planning to use the money anyway, and you know it's going to sit in a retirement account, it's a great way to put it, where you can earn better returns than likely what you'd be earning on a stock market or in a lower rate CD or money market type account. The key takeaway points that I would like everyone to end this session with are that oil and gas investing is a great resource for cash flowing passive income. These investments are generally structured to be very simple and quick for easy execution, and the asset ownership can be passed down to beneficiaries when you pass away. We all know everyone is going to inevitably pass away, and as a retirement account custodian, we make sure you list who your beneficiaries are going to be, whether that's individuals or a trust, however you have it established. At the time of your passing, the ownership of these investments can actually flow down to the next person in your lineage or on your beneficiary list, so that they continue generating that passive income from the asset that you set up and made the investment into. Final point that I'd like to make before my case study: it's very important to invest with people you know, specifically in self-direction. I already gave you the disclaimer about doing your own due diligence and research, but build your network. Check out your local investor groups, your local community, meetup groups, different places you can find like-minded investors that have very similar investment goals that you're looking for, because you may be able to talk amongst each other, find out who's a good person to go do a deal with, who is a less reputable group. Make sure you do your due diligence. We always try to provide the best education and content. We bring on great guests and great experts like Jim. So use these resources in front of you to try to build your network and build your net worth through that as well. So jumping into my case study, I'm going to cover this real quickly, and then we'll go ahead and turn over to Jim. But this case study, at its core, is just showing you how simple it would be to make one of these investments with your retirement dollars. So I've got an individual named Andy who has a managed IRA account, and he's just not happy with the returns he's receiving. He meets Tim, who's a mineral rights investor, and they discussed opportunities and agree to a deal in principle. Tim provides Andy with the purchase and sale agreement for a $100,000 investment and a management agreement so that Tim is overseeing that $100,000 investment on Andy's behalf, because Tim has the expertise in this industry. Oh, sorry, my wheel tracked there. So opening the account is a very simple and straightforward process. It only takes about 15 minutes or so to complete our application. We'll get that transfer request submit to the current custodian and have the client, Andy, notified as soon as the funds are received and hit his Advanta IRA account. Once that is done, we also start coordinating the investment transaction. So the transaction in this case is going to involve two separate documents: a purchase and sale agreement and a management agreement, as I outlined on that last slide. All of that paperwork needs to list Andy's retirement account as the investor and the tax ID number for that retirement account, as opposed to Andy as an individual or Andy's social security number, so that it all flows properly for the IRS's sake, and that Andy does not have any personal taxable liability or consequence for making this investment. Once the paperwork properly lists the retirement account and is approved by Andy, the account manager for Andy will execute the transaction, send Tim the funds, typically via wire or check, and then facilitate that all the profits of the investment flow directly back to Advanta IRA into Andy's retirement account. Again, either on a tax-deferred basis or a completely tax-free basis, meaning the funds come in, no taxes are handled there at that point in time. If it's a tax-deferred account and Andy is ready to start drawing out of his retirement for whatever purposes or needs he has, that is when that money is taxed, when he takes it out of the retirement account via a distribution transaction. If it's a Roth account and he draws money out, no taxes ever to be paid. He already paid taxes on that money. And again, Andy can continue to take this cash flow or get rid of the asset. He can sell the asset at any point in time for a lump sum profit on the ownership of the actual the purchase and sale side of the investment here. Closing up my side of things today, please check us out with our events. We put on 2 educational webinars like this a week. We have a podcast called the Alternative Investing Advantage Podcast. You can always watch our catalog of recorded webinars on Advanta IRA's YouTube channel. And if you're interested in some of the industry specific news in self-directed retirement accounts, we have a blog that we typically post to follow different legislation changes and different really insider information about the retirement investing industry. It's very quick to get a self-directed account started, 15 minutes to complete the application. Getting the account funded typically takes roughly a week. I will help you through that if you just reach out and tell me where your funds are coming from and what type of plans you have. And then you can start investing typically within about 10 to 14 days. You can have your first investment in your retirement account and start generating your retirement earnings through self-directed channels. And without further ado, it looks like Jim's screen is up and ready. Jim, the floor and microphone are yours.
Thanks, Corey, and thanks everybody for joining us today. So rather than go through like a bullet point bio, I think it might be better to tell a story. And I'm going to start in Vegas. You know, the Vegas casinos have mastered the science of separating us from our money. And how do they do this? They've got entertainment, the lights, the food, and inside the casinos themselves, there's no clocks, there's no windows. The bright lights are bright, the oxygen is pumped in the air to keep you alert and staying longer, playing games longer. They let you win just enough money to keep you coming back, and there's always the lure of winning the big jackpot. But at the end of the day, the house or the casino always wins. Now, you may not consider yourself a gambler, but you probably have gambled at a different type of casino located called Wall Street. Let me explain. So back in 2008, I was a registered investment advisor managing people's money. And fortunately, I was following hedge fund managers rather than the mainstream media. And some of those hedge fund managers were highlighted in the film The Big Short. So we were able to get our not avoid largely the crash. But what did we learn? We learned that the Federal Reserve Chairman, Ben Bernanke, lied to us. We learned that Hank Paulson, the Treasury Secretary, lied to us, as well as Tim Geithner. We learned that the women lied to us. And we learned that the talking heads on CNBC lied to us. Yet the banks got bailed out to the tune of trillions of dollars. How many bankers went to jail? 0. What did we get? We on Main Street had our 401k go to 201k. So this got me looking, there had to be a better way. And I started hunting around and I stumbled across something called oil and gas royalties. I'm in the Carolinas. I had never heard of oil and gas royalties. I didn't know they existed, didn't know what they were. But what I read really piqued my interest. So I went out to Texas for 6 weeks. I took a class on royalties and I started asking a lot of questions, spoke to all kinds of industry insiders. And basically I came away with, this is the best asset I have seen for building multi-generational wealth. Real wealth, not paper wealth. So let's dig a little deeper. You know, back when I was managing money, let's say in 2000, maybe a client comes into my office and you've probably heard a similar story or know people that have had this similar story. So this 35-year-old couple comes into my office, they've got $100,000 in their IRAs. They want to retire at 65, and what do? Well, I, like many financial advisors, would have told them, you're young, put the money in the stock market, it's going to go up, it's going to go down, but you'll average about 10%. And your $100,000 will be worth roughly 1.75 million at 65 when you're ready to retire. Well, that was in the year 2000. It's 23 years later. Let's see what happened. Well, first of all, they lost half their money. Then they got it back. Then they lost half their money again. Then they got it back. And now they're almost 15 years later and they've earned nothing. But then the market starts to go up and they start making money. Those are the ups and downs many financial advisors will tell you just have to sit through. So now you can see the market's gone up. Let's give a checkup. They're not 35 anymore. They're 58. Okay, well, they're nowhere near their 1.75 million and they only have 7 years to go. They actually have less than $300,000. And they didn't earn 10% a year. They earned 4.5. Like the casinos in Vegas, the casino in New York called Wall Street has mastered the science of giving you the illusion of these big giant returns, but in reality, the chart we just looked at is not a one-off. If you extend it all the way back to 1900, it's happened 4 times, and oftentimes more than 20 years of earning nothing. This is where the alternative comes in. What did I learn about royalties? What did I like about them that really intrigued me? First, it's decades of monthly income. Many of these wells were produced for 30 to 50 years or more. There are wells producing still today that are over 100 years old. Attractive returns, yield, typically 12 to 15%. It's inflation protected. Your income, your royalty income from oil and gas goes up when the price of oil and natural gas goes up. It's deeded title real estate, no Wall Street shenanigans. It's multi-generational, as Corey mentioned earlier. Many times families pass these investments down to their beneficiaries, their children, their grandchildren. There's no expenses and there's no liability. So how does it work? Well, there's 3 parties involved. You've got the oil and gas companies, you've got the surface landowners, and you've got the mineral rights owners. And it's important to note here that in the United States, it's unique. In this country, the mineral owners can be private citizens. In almost every country in the world, the mineral owners are the government. So here in the US, private people can own the mineral rights. And how this works is you've got the surface landowner, maybe they have a farm or maybe they have a ranch, and there's oil and gas beneath the surface. And the oil and gas company wants to drill a well. So what they do is they negotiate a lease with the mineral rights owners. And in that lease, it's going to state that the oil and gas company is required to pay a royalty on all of the oil and gas production to the mineral rights owners. It's the equivalent of if you bought a Chick-fil-A franchise and every month a percentage of your gross sales has to be paid to the Chick-fil-A corporate. So in this sense, once the well is producing, the franchisee of the oil and gas company has to pay the royalty to the mineral rights owner or Chick-fil-A corporate, as an example. We are Carolina Natural Resource Group. What do? We've got 30 years combined acquisition experience, but more importantly, we have built strategic relationships. And that's the importance of that is that these assets have been hoarded by the oil and gas companies themselves, university endowments, and families that just keep them in these assets in the family for decades. But it doesn't mean there's not room at the table for people on Main Street. There is. You just have to know who to talk to and where to look. So what do? When we acquire royalties, we want to minimize risk. And largely, you can mitigate the risk in oil and gas royalties outside of the oil price and the natural gas price. And we do that by acquiring assets where there's well diversification in terms of many wells, both oil and natural gas, multiple companies that are operating and drilling and that have experience, multiple reservoirs, so different geology, different states in the country. Attractive current yields, typically 12 to 15%, occasionally more. But we also want future growth for the future generations. And what that means is, we want acreage where there's space for the oil and gas company to drill a new well at no expense to us as the royalty owners, but yet we get paid our royalty on that well because it's on our acreage. That is future growth for my kids or my grandkids and your kids and your grandkids, future generations. And we invest in every acquisition. So when we offer an opportunity to investors, you are investing side by side with us. And in closing, we don't think that the question is, should you invest in Wall Street type investments or should you invest in real assets? We think the question is, what percentage of your portfolio does real assets like oil and gas royalties deserve? What seat at the table are you going to give it into your portfolio? And that starts with a conversation, which we are open to. With that, we'll open it up for Q&A.
Yeah, Jim, there are a few questions that have come in here. The first one, I know you mentioned that a lot of the industry in itself is kind of taken up by generational investors that are already in place. Why do people sell their royalties when they already have them? Or if someone were to make an investment, how can they sell them later?
That's a great question. We get it all the time. Typically, there's I'd say 95+% of the time, the reason somebody is selling to us is one, they inherited it from their grandparent and they don't want the monthly cash flow, they want the lump sum. Or, and it's generally the third generation, not the second generation that's inheriting it. Or it's a company or maybe an individual that has a large oil and gas royalty portfolio and they're selling 1/30th or 1/40th of what they own, just a small sliver to raise cash to go do something else they want to do. So that's typically why somebody sells to us. Occasionally it's something different, but not very often. How do you sell? It is real estate, so it does take some time. Oftentimes people call us, hey, I'm looking to sell, what do I do? Although we've never had somebody sell, but you could call us. Or you can go, there's a couple of auction firms, you can go try to auction it off and try to sell it that way. Or you can just talk to people as well. It's real estate.
All right. How long do the wells typically last?
Typically, they'll last 30 to 50 years. Every well's a little different because the geology is different all over the country. We have the technology, and it's been in place for decades, to actually go back into many of these wells and re-stimulate them to make them last 60, 70, 80 years. So it's typically decades.
Okay. And here's another question. This one, I'm not sure how you want to take it, Jim. The question is, what is the minimum investment amount? Now, that could be, what is the minimum investment amount for Carolina Natural Resource Group? That could be the minimum investment amount for a general investor trying to get into the space of oil and gas royalties. However, you're comfortable answering that. If you want that person to reach you directly for investing with you guys, I implore you to also have them, or I implore you, the person asking that question, to reach out to Jim. Sorry.
Yeah, there is no set minimum. It really depends on, the operational side of things. Because this is deeded title real estate, if we had 100 investors come into an opportunity and there's 5 counties, we're talking 500 deeds have to get recorded. So we might make the minimum investment a little higher. Whereas if we had 10 investors and there's 2 counties involved, maybe the minimum investment's a little lower. So it just depends.
Got it. Let's see. Someone asked if you have performance of, do you have performance of Carolina's performance showing 12 to 15? I think they're just asking like a track record question. Again, for something like that, I more so implore the person that asked that question to reach out to Jim directly and talk with his team and get some of those logistics in a one-to-one session where you could learn more about what they actually have going on.
Yeah, and every opportunity is different. Just like 2 houses on the same street are going to have a little bit of different features, so the price is going to be a little different. Same thing with royalties. Every opportunity is a little different. One might have more oil, one might have more natural gas, one might have more wells, one might be in 5 states, one might be in 3 states. So the performance is a little different, which is why I gave the range.
Exactly. The next question here, are there tax advantages with oil and gas royalties? And then a separate question related, and would they apply within an IRA? Just as far as the IRA goes, the IRA is in itself seen as a disregarded entity for tax purposes. So it's more so a question for Jim about the oil and gas royalty tax advantages. The retirement account kind of just flows freely from that perspective, at least from my side of things from Advanta.
Yeah, that's correct. When you own royalties outside of a retirement account, there is a tax advantage. If you owned a building on your tax return, you're allowed to depreciate that building over typically like 30 years. With royalties, you get, instead of depreciation, it's called depletion. So on your federal return, let's say you made $100,000 in income from royalties, the first 15% is you get a depletion allowance. So you're only paying federal taxes on $85,000.
Got it. Next question here. How would I sell my royalty? Do I sell it back to Carolina? I believe when they're saying Carolina, they're referencing your group. But if someone had royalties and they wanted to sell them, do they look up a group like yours and say, hey, I have this. Are you interested in buying this? Is that how that typically works? I know you covered it from a larger perspective, one of the earlier questions, but this came up afterwards.
Yeah, and that's fine. And if if you go do a Google search on oil and gas royalties, you will find hundreds of pages of companies that buy oil and gas royalties. You might find three, four, or five companies that will sell. So you have lots of options to sell to, not many to acquire from.
Got it. I actually had another question here. In purchasing residential real estate, I've seen a addendum or an amendment to the contract relative to oil and gas royalties being retained by the seller of the property. Is that similar to what we're talking about here, or is that separate, residential versus commercial in the grand scope of investments?
That addendum will be referring to the mineral rights. So let me just go back to the slide, be easier. So that addendum is going to refer to the mineral rights owner who owns what's everything below the surface, whereas the residential house, is on the surface. In this country, those two people can be different. The surface owner is not always the mineral owner, and vice versa. Oftentimes, it's different people. And oftentimes, the mineral rights owner, there might be hundreds of them in one area. What ends up happening is, if it's only, say, 10 acres, well, when the oil and gas company wants to drill a well, oftentimes those laterals are 2 miles long. So they will pool 640 acres or 1,280 acres together, which is with 1 or 2 square miles, and then do the math as to who gets what percentage. So yes, that addendum on a residential home or real estate is referring to the mineral rights owners. And if there's oil and gas there and they want to keep it, they want to keep it for a reason. It is very valuable.
Got it. No, that was a question that came in from the audience, but I also, where I live, I remember signing something like that when I bought my house. There's a creek on the side of my property, and I always I knew, from working with you, Jim, about things like this, but I didn't ever have an envision of it applying like I have with your little cartoon right here, and thinking about the circled house being the house I live on. All right, here, let me jump back into the questions.
For those that are old enough, the royalty owners are the Clampets from the Beverly Hillbillies.
I'm not old enough, but I do get the reference. I've at least heard the reference a time or two. Sorry, I'm tracking back where I left off with the questions here. There was a few that came in and pushed the list down. What are the risks we should be aware of with the royalties in the oil wells?
That's a great question. There are some risks. It's not no risk. So the main risk in our view is you want to make sure you own the acreage. You don't want a security or a fund, or you want the acreage. And there's two ways to think of this. Now, yes, the mineral rights are everything below the surface, but I have seen oftentimes where that depth has been severed. So somebody, just like the addendum to the real estate where the seller of the house is going to keep the mineral rights, sometimes the mineral rights seller will keep, everything going down to 10,000 feet or everything below 10,000 feet and only sell the difference. You don't want that, because in many areas of the country where there's oil and gas, there's multiple layers at different depths of oil and gas. So if you only own the minerals, for example, down to 7,000 feet, and there's a well at 5,000 feet producing and paying royalties, well, if they drill a new well at 10,000 feet, you don't get it. So we absolutely avoid severed depths. We only acquire all depths to the core of the earth to avoid that risk. Again, it can be mitigated. Another risk is if you picture a big ranch and you've got 5 wells on that ranch currently, and there's room for, say, 10 more wells, right, on the surface side. Well, as the mineral rights owner, if you buy what's called well bore only on the current 5 wells, and the oil and gas company drills a 6th, 7th, 8th, 9th, 10th well, you don't get paid. You only acquired the existing 5 royalties on the existing 5 wells. That's called well bore only. Again, something we completely avoid. Risk you can mitigate away. Apart from that, the risk really is commodity price. When you look at your royalty check, it is how much oil and gas came out of the ground and what price of oil and what price of natural gas did it sell for. That's what the check is every month.
That's very interesting. I would be very upset if I made an investment into those 5 wells and then they came and drilled 6, 7, 8 more and I didn't have that boring sorted out. That would be very frustrating.
Right, right. It's just simple. It's simpler to just avoid that.
All right, so the next question, will we be able to know what companies we are investing in and will we get statements showing the performance?
Yes, it's not performance. So it's not like traditional Wall Street stuff. It's real estate. You will know the oil and gas companies ahead of time. Whenever we have an opportunity, we provide this check stubs, like typically the last 3 to 6 months of that opportunity that we've acquired. And so you can see the check stubs, which it's not just a physical check, which has the total amount that the royalty owner gets paid. It has the detail, and that's what I mean by stub. And that detail will show every well and how much oil and gas came out of it and what months. Oftentimes there's multiple production months. So I've seen check stubs that are 300, 400, 500 pages long because it has corrections from previous months and it's got the current month and it's got 50 wells. But yeah, you get that detail every single month.
And here's a question that relates very much to exactly what you just answered. And then I have another 2 questions that relate to each other to follow that up. Will I be owning a specific well mineral right or a pool of mineral rights in that Carolina group owns? Is there a independent agency that rates such pool?
If it's a pool, like you like described as this, that's a fund. That's a security. We don't do that. It's deeded title real estate. So if we own, let's say we acquire royalties in 10 wells in a county in Texas, and you buy half of that from us, you're going to get a deed in that county, and then you're going to get put into pay directly with the oil and gas company. It is not a fund. It's not a pool. There's no rating agency.
Got it. And
You
then
own
the
it
other,
specifically outright.
sorry, Jim, didn't mean to.
Yeah, no problem. Sorry.
The next, again, there are 2 questions here that kind of intertwine with each other, at least in my eyes. The royalties go into the IRA tax-free. They're only taxed when you withdraw from your IRA, correct? Or would you report the royalties that are received annually on your individual income tax return as they are earned? So from the IRA standpoint, I'll answer that. They flow back into the IRA tax-free, and you are only taxed on tax-deferred money or tax-deferred retirement accounts when you withdraw from the IRA. You would not need to report any of that when it's held in a retirement account for any income tax purposes or anything like that. Now, the second side of it, and just to add Jim's input, what would the scenario be for investors that are looking to do this outside of a retirement account as far as tax reporting or returns? And then what documents are provided to the investor for tax return preparations?
Good question. So when you own royalties with non-retirement account money, the oil and gas companies will send you a 1099 at the end of every year, and that goes on your tax return. It's passive income.
Simple and sweet. That's how we like it with self-directed investors.
Yeah.
How does an investor get diversification with this type of investment?
That's a good question. We try to build diversification into every opportunity we bring, but if you want more diversification than what's offered, maybe let's say you earmark $100,000 for that you want to put into royalties. Maybe you split that into 2 different opportunities to provide more diversification. But we typically offer it in every opportunity.
Got it. This next one's kind of long, so bear with me. It's actually a 4-prong question in 1 question submission, so I've got to scroll as I'm reading it off.
Okay.
How liquid is an individual investor investment? How long before the individual investor receives a return on his monies? What is the minimum amount of time required for an individual investor to maintain his investment without penalties if sold? And the 4th leg, what would be the effects on the individual investment's returns if market energy prices were to decline?
Okay, good question. I'm going to start from the beginning and then go to this, like where you acquire it and then to the end where you sell it. So when you first acquire royalties, it is a process to get your first check. but you have an effective date on your deed. Let's say the effective date is August 1st. Well, you acquire it next week, and the effective date's August 1st. The deed gets filed, say within 3 or 4 days after your investment. That deed gets sent to the oil and gas company. The oil and gas company is going to quote you, that it's going to take them 90, maybe 120 days to process the accounting transfer. However, so 3 or 4 months before you get your first check. However, your first check will come and have the oil and gas royalty on the oil and gas production from your effective date, which is August 1st. So you don't get a check for the first few months, but then once it starts, you have all the back pay to your effective date. Secondly, when you want to sell, because it's deeded title real estate, you can't sell like a stock or a bond or a mutual fund and get your money in 3 days. It's a process. It could take a couple of months. It doesn't typically take forever, but it could take a couple of months. And I think there was a third question of how does the commodity price affect the rates of return? It's pretty simple. Let's say you're earning 10% for simple math, and you acquired when oil was at 80 bucks. Well, if oil goes to 40, once it does that, the oil coming out of the ground that month that it's at 40, when you get paid your royalty, you're not earning 10%. Now you're earning 5. It's directly correlated, assuming the same amount of oil comes out of the ground. Again, every royalty check is a multiple of how much oil and gas comes out of the wells times the price the oil and gas was sold for. So if the oil and gas prices go down, but production's flat, your yield's going to go down. Are you going to get a statement showing your $100,000 is now worth $50,000? No.
Got it.
I think I answered all 4 of those.
No, I do. I as well think you answered all of them. A few questions came in as you were answering that, of people asking about the recording. If you are here with us live, you should receive a copy of the recording via email within the next 1 to 2 business days. Those of you that are not able to attend when you sign up for these webinars, we always email you the recording roughly a day or so afterwards, or you could find it on our YouTube page. As soon as we email that recording out, that means it is posted on YouTube and it will live there in perpetuity. So you can listen to me and Jim on whatever recurrence you need to get through some of the nuances of these questions and answers. One of the people mentioned that they love the Q&A, but it was going a little fast, so they want to just listen back to it at their own pace. Please feel free to do so. No, I don't think that's a negative at all. We're getting through some great information and answering some great questions from the audience. So let everyone have a chance to listen to it when they can pause and rewind. I do that at home all the time.
Yeah, or feel free to call me or shoot me an email. I'm happy to have a conversation.
Yeah, I definitely think you'll get some phone calls, Jim. There have been a number of people that asked, kind of more personalized questions or questions about your opportunities and what you've got going on. So that's why we've got your contact information here on the screen. Hopefully people will reach out to you and see what's going on. Last few questions I see here popping in, and just a reminder for those of you, if you've got a question, please feel free to ask it. We've got a bit more time here. If the audience keeps putting them in, we'll keep asking them to Jim. So the next one I'm looking at here, you already have the real estate with oil and gas, correct? Or would the investment be invested with the hope of finding oil and gas?
That's a good question. We do not acquire mineral rights where there's no wells. That's part of mitigating the risk. Now, we know where the oil and gas is. So does the oil and gas companies. In fact, I've got software that pools together all the state regulatory data. I can see every well in the country. I can see every permit in the country. I can see every drilling rig in the country. But we at Carolina Natural Resource Group, one of the ways we mitigate risk is we do not acquire minerals hoping for the oil and gas company to drill a well in the near future. That provides you 0 rate of return until that well is drilled. You're just sitting on raw land. So we always are acquiring where mineral rights, if you will, where there is producing oil and gas wells already, and we can analyze the economics.
Got it. Someone asked here, what is the average return on investment? I think you mentioned, at least at the outset, they typically yield a initial return of 12 to 15%. Can you speak on that just a little bit further, Jim?
Yeah, and it's going to depend thereafter. Okay, so going forward, it's going to depend on what does the price of oil do? What does the price of natural gas do? What does the production of the wells do? If you're following these markets, you can go easily find recent articles where everybody is now saying, lots of analysts, meaning everybody, that by the end of this year, worldwide, we're going to be in a supply deficit of oil, 2.5-ish million barrels a day. That's bullish for prices. When it comes to natural gas, it's more of a regional commodity. So the prices in the US are different than the prices in Europe or Asia. And in the United States, we've got a big bullish wind, if you will, or whatever ahead of us for natural gas. When you go to the Federal Energy Regulatory Commission's website, you can find that in the next 3, 4, 5 years, we as a country are going to triple our liquefied natural gas exports. That is going to put a drain on supply. They either have to drill a whole lot more wells or prices of natural gas have to go a lot higher. Even our own Energy Information Agency is calling for north of $4 natural gas next year. We're sitting at 250, 275 today. Recently, it was just 220 because starting in the first quarter of next year, one of these first liquefied natural gas facilities that are under construction, it's going to come online. And these aren't, things that have been permitted or approved by the government. These are facilities that are literally under construction and have long-term contracts in place to sell the gas.
Interesting.
I think that answers the question. So
Yeah.
the return, well, let me go back. Something else that affects the returns. If they drill a new well on the acreage, your royalty income is going to get a bump from that because now you're getting a royalty check on a new well that you didn't previously own because it wasn't drilled. And when they first drill these wells, the production is really high because the pressure is so high. It's just like, when you pop a balloon, lots of air comes out at first, and then you have to really squeeze to get the last parts of air out. It's the same concept. So your royalty check could go up. It's definitely going to go up. It could go up a little, or it could go up a lot. I know somebody that acquired from us a gas royalty back in 2017. They were making about $6,000 a month, about 15% on their investment. 3 new wells got drilled, and all of a sudden they made $50,000 in 1 month and 50-some thousand in the next month because those 3 new wells were so massive. Now that doesn't happen to everybody. Their percentage could have been so small in the acres that maybe their check only went from 6,000 to 8,000, but it could be huge.
Sure. Do you need to be an accredited investor to invest?
No, you do not. It's not a security. It's deeded title real estate.
That actually came in from the audience, but I should have thought to say that out loud myself without an audience member throwing that one out there. Next one here. So if we put 100,000, we get tax deductions of 100,000, and we get royalties of 100,000 in 5 to 7 years. We never get the original 100,000. Is this correct summary? I believe that in context of a non-retirement account related investment because they are referencing a tax deduction. But can you just clarify the structure of the overall transaction that would be outlined there? 100,000 for 5 to 7 years.
I don't really understand the question because if you invest $100,000 with non-retirement account money, you do not get a $100,000 tax deduction. I don't know where that came from. Maybe they're thinking of drilling. When you invest in oil and gas drilling, you take on all the risk of that well and all the expenses of that well, and you get a large tax deduction, typically 70 to 80% of your investment. But that is the deep end of the pool and the risk end of the pool. Royalties are on the opposite end of the swimming pool, and we don't have any of that risk. However, having said that, if you're earning, say, 12 to 15% a year, you can expect to earn your principal back in, say, 6, 7, 8 years. And then after that, the royalty income is gravy. But you still have your principal. If you wanted to sell your minerals as real estate, you could always sell it.
Got it.
I think that answered the question.
I think that answered the question as best as either of us could, just because there's some nuance there that probably would need to be explained a little bit further. But I think hopefully we were able to give some good response there. Next one, my IRA is in a very aggressive fund, which I'm happy with. Can I remain in this fund and have the royalties go into my current IRA? Just to answer from my side of things, because that seems more so a retirement account structure question, you can keep your current IRA in the aggressive fund. That custodian, however, may not allow you to make these types of investments. So you may need to set up a self-directed account. And at that point, you make the investment into the oil and gas with the self-directed account. And as you yield those returns, you can flow them back into your other managed IRA via a custodian to custodian transfer as frequently as you want, any dollar quantity that you'd like. So really, it would be setting up, in this case, probably a second actual account, because the account you have is not going to allow you to hold these types of assets, but then the cash can flow between those two accounts as freely and as frequently as you would like.
Yeah, just to expand upon what Corey just said. So if you have 500,000 in your IRA number one in this aggressive fund that you like, you set up IRA number two with Corey at Advanta. You move 100,000 from IRA number one to IRA number two. You acquire royalties. Once it starts cash flowing and that monthly income starts coming in, you take the cash that's built up in IRA number two, transfer it back to IRA number one, put it back into the aggressive fund.
Exactly. Yeah. Jim just was kind enough to articulate what I was trying to in much better articulate words.
Well, I was a financial advisor for 15 years, so I understand the language and the lingo and how it works.
All right, next one here. In recent years, what have been the impact of the federal government's restrictions on domestic oil and gas exploration/drilling and the company's ability to locate suitable investment sites?
There's really been no impact on locating suitable investment sites. There's been rhetoric, a lot of rhetoric in terms of permitting on federal lands. I haven't seen many royalties on federal lands. Oftentimes they're on private lands. So whatever the federal government or the talking heads in DC want to say on TV, it doesn't really matter. The oil and gas companies are going to do what's best for the company. When you go look at Exxon or Chevron or any of the EOG, they are drilling where they think they can make the most profit in light of what the commodity price is, or they have that original lease that, remember back in the graphic, when they negotiate that lease with the mineral rights owner, they have a certain period of time to drill a well or the lease expires. So you'll see them go drill the well just to hold that lease, because there'll be language in there that the lease does not expire as long as there's a well that's producing. It's called held by production. But when they're in a new area that they want to explore, they're going to make sure every one of those leases gets held by production by drilling at least one well, regardless of what people in DC say.
So they're like putting a rock in a door jam to keep the door open for flow later. Yep.
Right.
Okay. We've got our last two questions here, and I see we're getting right about the threshold of our 1 hour time slot. So just to be mindful of Jim's time and of our audience's time, we'll probably wrap it up after about 3-4 more questions. If you guys want to get last minute questions in, I'm going to go through these two that I have here, and then if we're at time, we'll cut it out. Do your company know the average production of oil or gas that a well produces per day? And do you have a certain percentage of production from a well that you will consider buying depending on the average production of the land/well?
So the software that I have access to see every well in the country, I can see the production data, but it's not by day, it's by month. They're required to report that to the state regulators, and then that software pools all the state regulator data. So if there's a well in Texas, I can go look it up. I can see how much oil came out of that well in every month it's been producing, how much natural gas has come out. And the way we acquire this stuff is really we look at the check stubs and we look at 3 to 6 months, so we get an average of the commodity price and an average of the production, and we acquire based on economics based on that. Obviously, it has to check all the other boxes, such as not well bore only, not severed depths. We want the acreage. We like the operator. It has to blend with another deal, another opportunity that we're acquiring. But in general, when we look at a check stub, we're going to make an offer based on the economics on how much is coming out on the average over 3 to 6 months. I hope that answers the question.
I think it did. That sets a precedent of what the actual data is as opposed to the per day, inquiry of the question. But I think that's still
Right.
clarified thoroughly. Can the return be reinvested if the original investment did not come from an IRA or 401k? I know I referenced earlier, that it's very easy to roll this money back in when you're using retirement funds. What does it look like for a non-retirement account investor, Jim, that wants to, either roll their proceeds directly back in with you or pool them together and make the next investment?
Yeah, you'd have to acquire a different opportunity. You can't reinvest it. Like if you had mutual fund A and it pays dividends and you want to reinvest those dividends in the mutual fund A, you can do that on these Wall Street products. With real estate, you can't do that. Think about you bought a house on a small street with a cul-de-sac and it's cash flowing. Are you going to be able to put back into the same house, or do you have to buy another house on the street? You basically have to buy another house on the street. Royalties are the same way. Unless we can find sellers in the exact same wells and the exact same acreage, you're not going to be able to reinvest into the same opportunity. You'd have to find a different opportunity.
Yeah, the seller, in theory, if I'm understanding properly, would need to be like your co-investor. You'd need to find someone that's co-invested into the exact thing you have and buy from them to just largen your market share of that specific holding, correct? Yeah.
Right. But now if we had enough interest in, say, an opportunity that people wanted to buy more, if I know the people we bought it from had more, I could go get more. Now, sometimes, generation 3 inherits from grandma and grandpa, but it gets split up, say, 10 ways, and only 1 or 2 of the family members are selling. Maybe there's a third or a fourth member that wants to sell. That happens fairly often. But outside of those factors, you can't just reinvest in the same opportunity.
Got it. And we'll go ahead and use this question I'm about to ask as our final question for today's presentation. Are all of your investment sites located domestically, or do you have international sites as well, Jim?
So as I mentioned earlier, I believe Canada allows private citizens to own mineral rights, and Australia. It is not my market, not my world. I don't know it. So everything we acquire is in the US.
Got it. Okay. Well, I think that we have done a very detailed and thorough Q&A with our audience, given them roughly about 30 minutes of just picking your brain. And on behalf of the audience, on behalf of Advanta IRA, thank you very much, Jim, for lending your time and your expertise to our audience, to Advanta IRA, to share so that people can walk away from this with a little bit better understanding of your lane of investing and way of generating this really, really strong passive income flow. So thank you very much for joining us, for participating. I look forward to having you on in another webinar in the future. Obviously, we'll run this back. I know you've done it even before I was your direct point of contact a few years back with my colleague Clay, but thank you. Thank you, Corey, and thank you for everybody for all the questions. Feel free to email me or call my cell. Leave a message if I don't pick up, and happy to have a conversation. Thank you.